Welcome to this week's monthly finance update. I'm Nicole Hoare, Investor Consultant here at Century 21, and Ben from Flint Group joins me back this month. Welcome, Ben.
Thanks, Nick.
Thanks for coming back. We thought it was really important this month to jump in. From our last time Ben and I met, we've had a lot of investors and a few questions around the, principal and interest or interest-only loans. So we thought it was really good to get in and do a bit of a whiteboard session, a bit of a visual for our investors or potential investors or upcoming investors. So Ben, the floor's all yours.
Okay, so thanks, Nick. So excuse the handwriting, but we'll go through this piece by piece. I think visually it's easier to interpret what we're going to go through if we're putting numbers behind it. So this is a basic scenario. We've got someone that owns their own home or primary place of residence. They've got 2 investment properties, and then we've got a bit of a breakdown to go through. So someone owns their own home, it's worth $1 million. They've got a loan balance of around $550,000. We're just saying the interest rate is 6% for this, and their principal and interest repayment is about $3,300 a month, okay? Over to investment property 1, we're saying it's worth $700,000. It's got a $560,000 loan, so that's at 80% of the property value. The interest rate is 6.5%, and we've got a breakdown between principal and interest-only repayments, and I will double back on that in a second. So top line is principal and interest, second line is interest only. Same again with investment property 2, $650,000 property, $520,000 loan, 6.5% investor rate, and then your principal and interest only repayments. So all of this wrapped up. Over here, we've got the total monthly repayment. So this top line is the combination of all 3 properties paid off principal and interest monthly, okay? The second line here is the primary place of residence, principal and interest, and then the 2 investor loans, interest only. And in this scenario, it actually works out quite nice. It's a $1,000 difference in cash flow costs per month, okay? So the questions that we've been getting are that, rates are high at the moment, cash flow for a lot of households is reduced with cost of living pressures and also the interest rates as well. So there's 2 parts of this. The first part of it is that, you've got an extra $1,000 a month in your pocket if you need it, whilst you're still being able to hold these properties, because in an ideal world, we don't really want to sell while everyone is selling. If there's distressed sales, then you're probably going to get less for these properties than you would of if you were to hold for the longer term, because ultimately we're in property investment for capital growth. The negative gearing and tax return aspect is great, but it should be looked at as an additional benefit to holding property. So that's sort of that part of things. The $1,000 a month. If we fast forward 7 years, I thought I would do a breakdown because it sort of gives you a bit of an idea of how your loan balances will look in a few years, holding the properties, paying them off. So the first scenario here is if we pay the minimum repayment on all of the loans, principal and interest on each property, we get a loan balance in 7 years, an amortized loan balance of $493, $502, and $467, okay? If we were to look at scenario 2, this is having both of the investment properties interest only. So we can see here that the debt is not reducing between the loans, okay? But we're now using this $1,000 to pay extra per month onto our owner-occupier mortgage. And you can see that the effects can be quite positive, okay? So we're quite a lot less in our home loan. Our investor loans are still the same. That's fine because that's tax deductible debt. Over this 7 years, if we keep paying the investor loans down, unless we were to buy another investment property or to capitally improve the property, so do some major renovations, we can't increase this investor debt if we find out after a number of years that, we're, with rental growth on rental income going up, these properties are no longer negatively geared, they're neutrally geared, or they're actually creating a tax burden each year. That's not worst case scenario, but if we've got the option to keep them sort of negatively geared on paper, or at least neutral, it's not an additional tax that you're going to have to pay on these two properties on an income tax side. We've got the $1,000 extra of cash flow going to this property, which is our primary place of residence. No tax deductibility is associated with these loans, so it's good to pay more on these properties. And what we can even do is that if both of these properties are still negatively geared and we're getting cash out of those at the end of the financial year, we've got sort of a return out of these properties, we can further put it on top of this loan, and you'll see that that will go down even quicker, because as your loan becomes less, the interest charge on your loan becomes less, your principal repayments will become more, and you'll watch years fall off this mortgage. So this is probably an easy way of just showing you of what your options are here, what you can do in terms of the cash flow cost. And this could even be a scenario where for the next 12 months, you're pocketing that sort of $12,000 annually to help with cost of living. And then once rates come down, or you get a pay rise, or your financial position improves, you can start rediverting those cash flows into paying off this mortgage, which is a great position, because then if you're looking at a property that's might be worth around 1.5 now, maybe more, you've got an increased equity position on there, you've got an increased equity position on these, even not reducing the debt on these. And then once this loan is completely gone, we can start pivoting the scenario and going, okay, well, do you want to acquire another investment property, or do you want to start paying some of this debt off? So yeah, it's a pretty good position to be in if you've got the loan structured correctly.
Thanks, Ben. That was really insightful information, and great to visually see it on the board for our investors and upcoming investors. Let's just nut it down really briefly. What's this look like for someone who owns their own property right now?
Yeah, so Nick, if you own your own property and don't have an investment property, or sort of, wanting to expand the portfolio, if you've got a property worth $1 million, there's a loan of $550 on it, the equity position, if we top it up to 80%, 80% is your standard benchmark. You're not paying any lender's mortgage insurance. There are certain industries that you could actually go to 90% with no LMI, and even if you do pay a little bit of LMI, it is just an opportunity cost. But at 80%, we've got sort of 330 grand of usable equity. So we could top this loan up to 800,000, set up a new loan split as an equity loan, to then go buy, it might be investment property 3 or investment property 1. And obviously the benefits, you've got the compound capital growth. If you're structuring an equity loan off one property to buy this, you're lending sort of 100% of that property. So from a tax deductibility side of things, pretty much anything you buy at 100% is going to be negatively geared, especially if you're buying a new property. There's depreciation aspects to it. And even if you're buying, a high yielding NDIS or commercial property, it would still be pretty neutral on paper when structuring like that. If you had cash to put into it, we could actually do something called debt recycling, where if you had 200,000 to put into something, whether it's an investment or you're not sure, we could actually pay 200,000 into this loan to bring that down to 350, to then top up a new loan of 200,000 to then go use to buy this property here. So there's a few little things that we can do structurally. So yeah, it's very, very important to sit down and have a conversation around this, because as I said before, once you start diminishing the debt on the properties, you can't really increase the debt. Some accountants can do a few things, but as a general rule, when the ATO onboards an investment property, they look at the purchase price, the loan amount, and so they do track the loan. So if they see the loans and another $100,000 more, they're going to pick that up on your tax return, and they're going to question what those are for. If it was for renovations or something like that, then that's fine. But unless it's for an additional investment purchase or something like that, the debt wouldn't be deductible.
Awesome. Well, we'll get this out to all our investors this month, and like Ben said, it's a conversation, right? He'll be able to nut out some scenarios. So that brings us to this week's finance update with Ben. Thanks for joining me again, and
Pleasure,
we'll talk
Nick.
to you next month.
Thanks, guys.